Okay, continuing with the PowerPoint lecture, we are now on transaction number 8. And this date on November the 22nd, Smart Touch Learning collected $2,000 cash from a client in transaction number 5. So if you remember, transaction number 5, we did work for a client, but the client hasn't paid us, so it went into an account receivable. They owe us money at a later date. So we've already done the work for this customer, but the customer hasn't paid. So that's the transaction that transaction number 8 is referring to. So again, let's go back to transaction number 8. We are now collecting $2,000 cash from one of those clients from transaction number 5. All right, so let's do this one. Let me get my PowerPoint up on my side. Okay, so cash is the asset going up, so that is your debit. And accounts receivable is also an asset, is going down because we're receiving money from that customer. Accounts receivable is going down. The amount of money that customers owe us is going down, okay, because we've collected a portion of it. So that's the journal entry. Now we're going to post. So posting cash November 22nd. See, we've got our date references here in our T account. That way, if the accountant, you or whoever in your company wanted to go back and trace these transactions, they'll know what date those numbers were coming from, okay? We've got cash going up, $2,000 debit. Accounts receivable going down, $2,000, okay? So that is transaction number 8. Transaction number 9, payment of cash dividend. November the 25th, a payment of $5,000 cash was paid for dividends. So my two accounts, cash and dividends. So cash is an asset going down, so that will be your credit, okay? Dividends is going up. We're paying additional dividends. Even though cash is going down because we're paying it with cash, our total dividends, the amount of money that we have or we are distributing to our shareholders, that amount just went up. We're paying our shareholders money. So the dividends, the total dividends were zero before November the 25th, but now we're issuing dividends. So dividends goes up, and dividend going up is a debit. Okay, and now posting, cash going down on November the 25th is a credit. Dividends going up is a debit, okay? Now transaction number 10, prepaid expenses, December the 1st. So the dates, they've been given to you, they've been entered into the journal for you. And your homework, there's a lot of them that you have to put the date in there, okay? So Smart Touch Learning prepays 3 months office rent. Now this was in another video in the Excel spreadsheet where we were going over examples of accounts, examples of assets, liabilities, and equity. This 3 months worth of office rent, that is an asset because that's going to benefit us in the future. That's going to benefit us for 3 months. So prepaid rent is an asset, okay? And that asset is going up. So that will be your debit. Okay, cash is going down. Cash is an asset going down because we've paid that insurance with cash, so that will be your credit. Post it to the general ledger or the T account. Cash going down $3,000, prepaid rent an asset. Going up is a debit, okay? All right, next. Transaction number 11, payment of expense with cash on December 1st. Smart Touch Learning paid employee salary of $1,200. So remember your steps. You know, these series of videos had to do with establishing the steps of recording a journal entry. Step 1, we had to identify the accounts affected. For this one, it's salaries, expense, and cash. Okay, that was step 1, identify the accounts affected. Step 2, determine if it was going up or going down. Okay, is my salaries, expense going up or down? Is cash going up or down? And then put it into a journal entry and then post it to your general ledger or to the T accounts. Okay, remember those steps. Identify the accounts. Step 2, decide whether each account is going up or going down and apply the rules of debit and credit. Step 3, record the transaction in the journal. Step 4, post to the ledger. Step 5, determine whether the accounting equation is in balance. Okay, so we've got salaries, expense. That is an expense going up, so that is your debit. And cash is going down, so that is your credit. And then post to the T accounts. Okay, here's another transaction. Transaction number 12, December 1st. Smart Touch Learning purchased a $60,000 building in exchange for a note payable. So, and yes, all of these, step 1 was already done for you. You already had the accounts. That was a hint down towards the bottom. We've got building and we've got note payable. Building is an asset, and in this transaction, building is going up. So that tells you that that number is going to be on the left or the debit side of the T account. Notes payable is a liability. That's going up. So any liability going up, that tells you that the normal balance is a credit. It's on the right side of the T account, okay? So, but you will have to learn how to do this, because in not all situations, will you be given the account names. Most of the time you're not going to be given the account names. You have to read the transaction and determine that for yourself. So with this one, building, notes payable. That's how we purchased this building. We applied for a loan from the bank, and the bank issued us a note payable saying that we promised to pay $60,000 back. So we're now in debt an additional $60,000. Okay. All right, transaction number 13, December 2nd, Smart Touch Learning received a contribution of furniture with a fair market value of $18,000 from Sheena Bright. In exchange, Smart Touch issued Sheena common stock. So we've got furniture and common stock. Those are your accounts affected. So furniture is an asset and it's going up. We're going to use the fair market value as our cost basis, okay, because we don't know that's the only dollar value we know. We're not given a value of the stock, so we're going to assume that it is of equal value. Common stock is equity going up. That is your credit. Posting it. Okay, we have 18,000 and 18,000 common stock. Okay, transaction number 14. We accrued a liability. On December the 15th, Smart Touch Learning received a telephone bill for $100. and will pay this expense next month. So it is a liability. And they use a specific account for this telephone bill. They call that, it kind of gets grouped in with utilities. So a lot of times, electric, water, telephone, they get lumped in under one account name called utilities payable and utilities expense. So utilities expense just went up, so that will be your debit. And utilities payable is a liability going up. That is your credit. Oops. Okay. Transaction number 15. They paid employee salary of $1,200. So we've done one like this already. Salaries expense is your debit. Cash is an asset going down. That is your credit. Okay. All right, transaction number 16, we have unearned revenue. On December the 21st, a law firm engages SmartTouch Learning to provide e-learning services. So we've got some service revenue. Oh, and agrees to pay $600 in advance. So this one, they've not actually done the work yet. It says they are going to provide e-learning services, and they agree to pay $600 in advance. So the company, the accounts affected will be cash and unearned revenue. Cash is an asset, and SmartTouch has received the cash. So cash went up, that's your debit. Let's talk about unearned revenue. Unearned revenue is a liability. SmartTouch now, because they've been paid $600, they now have an obligation to provide these learning services. So a liability doesn't necessarily have to be an obligation to pay money. It can be an obligation to provide a service, and that is the case with this one. Unearned revenue is a liability, okay? It is a liability. It's a liability to perform a service, okay, to perform a service. An example of this would be with the grass cutting example, with the lawn care. That was an example in another video I posted. Another example, very common, would be gift cards. We all buy gift cards as gifts, for family and friends. So if I go to Lowe's and buy my dad a gift card, Father's Day is coming up, and I buy him a $50 gift card, Lowe's has $50 cash that they just received, but they haven't earned it. They haven't sold me a product yet. So now when my dad goes in with that gift card, Lowe's has an obligation to to allow him to purchase something for the amount of the gift card. That will result in sales revenue. Okay, so gift cards, magazine subscriptions, anything that's that the company has received money for in advance and later has an obligation to perform that service or to sell a product. Earning of service revenue for cash. December 28th, SmartTouch Learning collected cash of $8,000 for service revenue that the business earned by providing e-learning services for clients. So this one, cash goes up and service revenue goes up. And then you would post this one. And yes, it will be indented slightly to